Welcome to this Killick Explains video, and welcome to part 2 of my very short series on inheritance tax planning using AIM shares specifically. Now part 1, in case you missed it, is all about the nuts and bolts of inheritance tax and why it remains a problem for a lot of families. This is more specifically about the underlying investment that might potentially, using something called business relief, see assets left outside the death estate and therefore not subject to inheritance tax of 40% in the normal way. So what are we talking about here? Well, number one, you've got a happy meeting of minds, if you like, in the sense that the government wants to encourage investment in smaller, growing companies. Meanwhile, investors often want to reduce their tax bills. Bring those together, and something called business relief, it used to have a different name, but something called business relief on unlisted shares, of which AIM shares are probably the best known example, if you like, not companies that are listed on the full London Stock Exchange list, but somewhere else. So unlisted shares, AIM shares qualify, potentially solve those two challenges. How? Well, there's 2 or 3 stages, if you like. So an investor needs to buy what are called qualifying shares in order to get this so-called business relief. They must be held for at least 2 years prior to death, and if they are, they may then be excluded from a death estate as part of a will, or they could be passed on while the donor is still alive with business relief, subject to some qualifying conditions. So what exactly would someone be buying in order to try and get hold of this business relief and a way of excluding assets from a death estate, let's say, or passing them on with no concerns about inheritance tax, because the relief is potentially 100% of the tax that would otherwise be due. All right. Well, AIM is basically a market for smaller companies at the London Stock Exchange, and it's attractive for a number of reasons. Regulation is relatively light touch compared to what it would be for a company on the full list, if you like. There are fewer analysts raking over AIM stocks, and that can be attractive for bargain hunters, for example. And typical candidates are young, fast-growing, and looking for certain things. They want capital, they want a degree of credibility, because they may be relatively unknown before they emerge onto AIM. They want the publicity of being associated with the London Stock Exchange, possibly for the first time, and some of them will have half an eye on the future and a potential full listing. So lots of reasons why these faster, smaller companies, faster growing smaller companies might come to this market in search of capital. Now, flipping that around, why would someone invest in AIM stocks? And I'll highlight 1 or 2 of the risks in a moment. First of all, you might be buying tomorrow's names today, to use a bit of a cliche. These are potentially the names of the future on their way to greater things. All right. Owning stocks with lower levels of analyst coverage can be attractive. If you know what you're doing, this is a place where there is less competition from the big banks, analysts, and so on in terms of uncovering tomorrow's winners. And of course, what I'm talking about here is potentially a way to reduce inheritance tax via business relief. And AIM stocks are a good place to go looking for what are known as by HMRC as qualifying assets or qualifying shares. Now, this all sounds great. So you're saying to me, Tim, that I just need to buy some of these things, they're fast growing, they're the names of the future potentially, and then I may get 100% reduction in what would otherwise be a fairly penal amount of inheritance tax. Well, nothing is given away for free by the government, that's for sure. So what can go wrong? And there are a few things to watch out for. AIM shares, because they are smaller companies, they're fast growing, can suffer from short-term volatility. Failure rates are relatively high. That's companies actually going bust and disappearing compared to, say, companies on the main list. Liquidity can be relatively poor, and dealing costs sometimes can be quite high. The gap between the bid and offer prices, the bid to offer spread, can widen suddenly in this market because of the relatively low dealing volumes. A stock may also cease to qualify for business relief. There are certain corporate events that can happen, takeovers for example, which may see it not qualify for business relief, and you never know for sure whether a stock's qualified until after the event, if you like. And also there's a danger here of the tax tail wagging the investment dog, as I call it. You shouldn't look for a tax solution and just completely ignore the risks of the underlying investment, if you like. It's kind of the wrong way around. Now, the final thing to watch out for is a technical point, which is that, strictly speaking, any AIM inheritance tax portfolio, let's say, so group of shares, doesn't reduce a death estate for the purposes of the resident nil rate band calculation. So there is a relief available. It's only available on certain shares, and you've got to be the kind of investor that's, A, comfortable with the risks involved, and B, understands how the relief works. And I have shortcut some of the detail in this video. I suppose what I'm saying there, therefore, is, always seek some advice on whether this is an appropriate solution in the context of your personal tax circumstances and some of the other things that you may have already set up to try and minimise tax. This is certainly not a one-size-fits-all solution. Now, if you'd like to know more on what is quite a technical area, whether it's inheritance tax, whether it's AIM, whether it's investing in small, fast-growing companies, whatever it happens to be, you could try my extensive video library. There's a shares tab in killick.com/learn. Another place to go is my How to Invest in Equities guide, which touches on some of this stuff. It's not sitting next to me, but it's got a sort of blue cover, editor at killick.com for that one. And you could also read our quarterly flagship magazine, Confident, and for a copy of that, often there is stuff around equity investing in there. Again, it's editor at killick.com.